Thank you for joining us at exam.com. In this preview video, we'll be looking at the CPIs for July out on Thursday. Fed Jerome Powell said at the last Fed meeting that the committee will be data dependent. They could hike in September, but they could also pause. I'm Cristina Marujos. With me today is our senior investment analyst, Geralambos Pisuros. Geralambos, markets seem to believe, though, that the Fed is done hiking this tightening cycle. Do you think the CPIs will justify this view this week?
Hello, Cristina. No, I don't believe that the CPIs will close the door to the likelihood of more hikes by the Fed. The headline rate is expected to have rebounded to 3.3% year over year from 3%, and the core one to have ticked down to 4.7% from 4.8%. But to be honest, I consider the risks surrounding those numbers as to be tilted to the upside. Yes, both the ISM manufacturing and non-manufacturing PMIs for July came in below expectations, but the new orders sub-index in the manufacturing survey and the prices charged sub-index in the non-manufacturing PMI rose by more than anticipated, which in my opinion suggests improving demand for goods and perhaps a rebound in inflation. That view is also corroborated by the S&P global PMIs, which sent a worrying signal that further fall in the inflation rate below 3% may prove elusive in the near term. And this is also supported by the higher than expected wage growth rate we got on Friday in the US employment report for July. What's more, the year-over-year change in oil prices rebounded significantly lately, suggesting that if the core CPI rate rebounds somewhat, the headline rate may increase by more. Therefore, a strong rebound in inflation after almost a year of cooling may prompt market participants to reconsider the probability of a September hike and also scale back their rate cut bets for 2024. Currently, investors are pricing in nearly 140 basis points worth of rate reductions for next year.
Markets will definitely be eyeing the data, the Fed as well, but let's turn to the market reaction now. We saw the dollar gaining these past few sessions, especially on the back of the Fitch downgrade. Could the inflation data out this week help it extend its recovery?
Yes, the data could do that. We saw the greenback pulling back on Friday after the lower than expected NFP number, resulting in a rebound in euro-dollar from the uptrend line drawn from the low of September 26th. But the pair pulled somewhat back again yesterday and today, indicating that traders are reluctant to assume a clear direction ahead of the CPIs, which, in my opinion, highlights the importance of this data set. So, accelerating inflation could add more fuel to the dollar's engines and perhaps push euro-dollar below the pre-mentioned uptrend line, paving the way for a test near the 108.35 barrier, which offered support between June 23rd and July 6th. That said, in order to start examining a full-scale bullish reversal in the dollar and thereby a bearish reversal in euro-dollar, it may be wise to wait for more data and Fed rhetoric to see whether and how strongly they support the higher rates for longer narrative. From a technical standpoint, euro-dollar may need to clear the key support zone of 106.65 to signal that reversal.
I see. Geralambos, thanks so much. This was a preview video. Thanks for joining us at exam.com.